This week, the world entered the second quarter of 2020 with more bad news than good. US stocks ended the first quarter down 20% in their biggest drop since the global financial crisis in 2008. And the number of coronavirus cases globally is steadily inching towards 1 million. Experts agree that investors need to brace themselves for a prolonged economic downturn.
The market contour of the global COVID-19 crisis is more likely to be a W or a U-shaped recovery going forward, as opposed to a V-shaped bounce, if we do not see a peak or an unexpected surprise improvement in the virus trajectory over the very short term. So what we do expect is more swings going forward, and we would not be surprised if global equity markets should retest the lows on the 24th of March that we saw, although it is still unclear if we will make a new low at a later point in time.
Yet despite the turmoil, the message to investors is not to panic and focus instead on long-term fundamentals.
The most important thing for investors to do is to keep in mind and stay focused on their long-term investment strategy and not react emotionally in buying and selling at this point in time. Now, in this market, leverage is generally a very bad idea. And for those investors who are leveraged, who are on margin, they should make use of any relief rallies to sell into strength, to try to delever and to build up liquidity buffers.
Experts say instead of completely pulling out of the markets, investors should focus on diversifying their portfolio. And one alternative investment could be Singapore government bonds.
The A35 ABF ETF holds a portfolio of Singapore dollar-denominated government bonds. And over the last 15 years, we have noticed a fairly consistent behavior in this ETF. That when markets are uncertain, when investors are fearful, when confidence levels are low, this ETF actually does better than normal. Under normal market conditions, the A35 ABF ETF returns about 2 to 3% per annum. But when markets are in distress, the returns actually do better. During this recent market uncertainty resulting from COVID-19, we have seen the stock markets decline about 22% from 20th of February till today. Very turbulent in mere 6 weeks. The A35 ABF ETF, however, actually traded up 1.8% during this 6-week period.
Nico says that this is consistent with the bond's performance during past crises, such as the global financial crisis in 2008. Singapore's handling of the COVID-19 virus has also been praised and has heartened some investors.
Investors tend to view the Singapore dollar as a safe haven currency, a very well-managed currency that is firmly backed by strong central bank reserves. Secondly, Singapore government bonds is AAA rated, one of the few nations in the world to enjoy this highest credit rating from all 3 credit rating agencies. And it has held this AAA rating throughout many crises.
Another risk mitigation strategy during this crisis could be impact investing. At its core, impact investing means to make an investment into funds that promise to make a quantifiable social impact as well as a financial return. It also subverts the traditional investing model of risk and returns.
There's a third element. So if you think about literally the graph, it's not just x-axis, x-axis and y-axis, there's actually a z-axis here. And we said there is a correlation of the 3, and the third element is impact. So what we see, from our analytics is any organization which actually is having high impact, and we measure this impact, we do see that the risk goes down. And why is that? It's actually very simple analysis. It is because this organization, be it bringing education, to the underserved, or clean water, or creating the livelihood, they're so integrated in the community that the community makes sure that the organization's health is actually in good shape.
Doreen Shanaz set up the Impact Investment Exchange more than 10 years ago after seeing the negative impact of the global financial crisis. The exchange manages 2 bonds under the Women's Livelihood Bond series, both listed on the Singapore Exchange. She says the lessons learnt from the 2008 crisis are applicable to the current situation as well.
You are investing in countries and sectors and with groups of people that your other investments are not touching, right? So even if your other investments have failed, this ones will be okay, right? They're not really linked. That it's still showing, for the time being, positive result. So which is very, it proves the theory that you have to be inclusive, you have to be diversified, and you really need to have different kind of assets in your portfolio.
Ms. Shanaz says that with more corporate supporters getting behind impact investing, including the Rockefeller Foundation out of New York and Singapore's own DBS Bank, more investors will see it as a means to diversify their portfolios.
One of our investors sent me a WhatsApp message a few weeks ago and said, literally, it said the markets are crashing and the WLB is up by 3.8%. That's Women's Livelihood Bond. Thank you so much. For me, that's a validation. And also it's a validation when we see the women that we're working with, that they are still have their jobs. We have created livelihood. We've impacted over 79 million women and their families. That, hey, maybe we're doing something right and we are contributing to having people lead a normal life during this time of crisis.